Howdy, y'all. Welcome to Liberty Call. Excuse me. My throat's a little froggy. Anyways, I am Raymond Dahlman, your humble host here at the Liberty Call. Thank you for being here today. It is, what day is this? Wednesday? No. Is it Wednesday or Thursday? What day is this? Wednesday, November 1st, 2023. Gosh, the days just get all scattered in my brain. Anyways, it is Wednesday, November 1st, 2023. It is Turkey Month. Yay. We got Thanksgiving in a few weeks, so that's exciting. And not that I usually have turkey on Thanksgiving because my wife doesn't eat turkey. And unless I've got a big family here, it's just going to be probably steaks at Ruth's Chris or somewhere like that. Anyways, all right. Well, I am glad you're here. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a likes, a shares, a subscribes, hit the notification bell because you want to know when I go live. Occasionally I say something intelligent. I mean, it's usually only once a week. So you got to watch all 5 days just to see if I say something bright. So anyways, today we got the big news, the Fed meeting, the Fed, press conference. They did not raise rates. They kept them at 5.25 to 5.5. Also got some other articles here, jobs data, some other economic data. The Fed, or the Atlanta Fed, seems to think that the party's over. So we'll see what happens there. So, all right, well, let's go ahead and get into the numbers for today and see how they turned out. Dow Jones was up 0.67%. I mean, the volatility was all over the place. I mean, markets were up, they were down, they were just back and forth. It was up 221 points, closed at 33,274. The S&P 500 was up 1.06%, closed at 4238. NASDAQ up 1.64%, closed at 13,061. The VIX fell 7.06% today. It's back down to 1686. Canada was up 1.09%. Brazil was up 1.8%. And Mexico was up 1.43%. In Europe, Germany was up 0.76%. UK was up 0.28%. France was up 0.65%. The Netherlands were up 0.51%. Spain up 0.64%. Italy up 0.88%. Switzerland up 1.08%. And Portugal up 0.94%. Russian exchanges both green today. The MOEX up 0.17, RTSI up 0.79. And the Asian markets look pretty good. The Nikkei in Japan was up 2.36, Australia up 0.85, New Zealand up 1% even. In China, the Shanghai was up 0.14, the Shenzhen Component down 0.38, China A50 up 0.84, DJ Shanghai up 0.03, Hang Seng down 0.09, and the Taiwan weighted was up 0.23. All right, so everyone's in a good mood for some reason in the markets. I don't know why, because it's like going down the train tracks and you can see like the bridges out, especially out here in Colorado. I mean, there's some pretty cool trains that you could take, through the little old mining towns and stuff like that. And, sometimes they got these gigantic span bridges. And, if it were to, go out, be like, over the side. So anyways. All righty. Well, let's go ahead and get to the economic recap for today. The market recap. U.S. stocks hold gains as Fed stands pat on rates. All right. Let's get to my notes here. All right. U.S. stocks showed some upward momentum on Wednesday, even as the Federal Reserve decided to keep rates steady during its latest meeting. The Fed's decision came despite recognizing a step up in the pace of economic growth, as indicated by recent indicators. Meanwhile, the October ADP private sector payrolls report came in slightly lower than expected, with 113,000 jobs added, although it still represented a stronger performance compared to September. September's JOLTS jobs openings exceeded economists' estimates, highlighting robust labor demand. Investors are eagerly awaiting Friday's job report for a more detailed assessment of the tight labor market, which is significant for both the Fed and investors. In the tech sector, AMD witnessed a notable rally, surging more than 8% as it downplayed weaker than expected current quarter guidance. AMD emphasized stronger demand for its artificial intelligence chips, and it reported better than expected Q3 results. The company expected to sell $2 billion worth of graphics processing units for AI program development, potentially benefiting its data center business. This development led to increased optimism around AMD's AI opportunities, allowing although UBS lowered its price target on the stock. The earnings season remained in full swing, with companies such as fintech firm PayPal and home sharing platform Airbnb among those scheduled to report their earnings. Norwegian Cruise Lines beat profit expectations, but provided Q4 guidance below expectations due to operational challenges caused by external events, including conflicts in the Middle East. Match Group, the parent company of Tinder, saw its stock decline by 17% after issuing disappointing revenue guidance for the fourth quarter. Energy stocks experienced slight gains supported by rising oil prices following data from the Energy Information Administration showing that weekly U.S. crude stockpiles increased less than expected. Overall, the market remained attentive to economic and corporate developments, while the Fed policy decisions and earnings reports played a significant role in influencing investor sentiment. So, kind of a good news, bad news. So, companies are still reporting, decent earnings, and they haven't really started the mass layoffs that we would have expected, but we'll see. Next up, Fed keeps rates steady as cautious approach to policy continues. All right. The Federal Reserve decided to maintain its cautious monetary policy approach during its latest FOMC meeting, keeping the benchmark interest rate within a range of 5.25% to 5.5%. This marked the second consecutive FOMC meeting where the central bank opted to hold interest rates steady, raising hopes that the Fed may not be inclined to resume rate hikes. However, Fed Chair Jerome Powell stopped short of ruling out the possibility of future rate increases, suggesting the central bank isn't yet confident that financial conditions are adequately restrictive. Yeah, because they did not raise rates at the September meeting. They raised a 0.25% at the July meeting, no change at the June meeting, and then rate increases January, March, and May. All right. One of the primary concerns for the Fed is the recent surge in Treasury yields to multi-year highs, which has led to tighter financial conditions. Powell and other Fed officials have acknowledged that tighter Treasury yields could help control rising inflation, but could also weigh on economic activity due to the elevated borrowing costs for households and businesses. Powell emphasized that the extent to which tightening financial conditions driven by higher long-term Treasury yields will impact future rate decisions depends on two key conditions. Firstly, it requires that these tight conditions persist over time, which remains to be seen. Secondly, it's crucial that the upward movement in long-term rates is not solely a reflection of anticipated Fed policy changes. While the central bank is concerned about the surge in economic activity due to the potential inflationary pressures, recent indicators have indeed shown a robust expansion in economic activity during the third quarter. The U.S. economy experienced a significant acceleration to 4.9% growth in Q3, supported by a strong labor market and robust consumer spending. In conclusion, the Fed remains cautious about the future course of monetary policy, particularly in response to the surge in Treasury yields. While this has the potential to control inflation, it is also seen as a potential threat to economic activity. The central bank refrained from indicating that it would rule out further rate hikes, leaving room for future policy adjustments based on evolving economic conditions. So basically let the door open to say, hey, well, we can either raise rates or not raise rates. But they didn't say anything about dropping rates. So any of the fools out there who are hoping for rates to go back down, I just don't think that's going to happen anytime soon. All right, next up, U.S. job openings stay elevated, layoffs at 9-month lows. The latest JOLTS report from the Labor Department revealed the U.S. job openings increased in September, underlining the persistent tightness in the labor market. The report also indicated a drop in layoffs to a 9-month low, with 1.5 job openings for every unemployed person in September. The U.S. labor market remains notably tight, surpassing the pre-pandemic ratio of 1.2. The Federal Reserve acknowledged the strength of the U.S. economy, keeping rates unchanged, but also left the door open for potential rate hikes to combat demand and inflation. The data showed that job openings increased by 56,000 to reach 9.553 million at the end of September, though the figure for August was revised downward to 9.497 million job openings. The September data exceeded economists' expectations, who had predicted 9.25 million job openings. Notably, the accommodation and food services industry reported an additional 141,000 job openings, while the arts, entertainment, and recreation sector saw an increase of 39,000 unfilled positions. Conversely, other services experienced a decline of 124,000 job openings, with 43,000 fewer job openings the federal government, and 41,000 fewer openings in the information industry. The tight labor market conditions have contributed to the persistence of hiring difficulties, with companies struggling to find workers, as evidenced by a rise in hiring to 5.871 million. This job openings rate remains unchanged at 5.7%, indicating the ongoing challenge of finding qualified employees. Layoffs declined by 165,000 to 1.517 million, the lowest level since December of 22, reflecting employers' reluctance to cut jobs. While the JOLTS report suggested a tight labor market, a separate survey from the Institute for Supply Management indicated a slowdown in hiring. Companies in the ISM survey reported a decline in factory employment in October. It's worth noting that work stoppages by the UAW union and the big three automakers Ford, General Motors, and Stellantis likely contributed to the drop in factory employment, which disrupted supply chains and led to furloughs and layoffs. Despite the prospects for a soft landing in the labor market appear to be promising despite some cooling off from its 2021 highs. Overall, the persistent tightness in the labor market supports economic growth, but could also keep the Federal Reserve inclined to maintain higher interest rates as it seeks to manage rising demand and inflation. So the labor market is not cooperating with the Fed. The Fed is trying to raise rates, which will squeeze the economy, which will then hopefully squeeze the inflation out of the economy by having less people buy stuff because they don't have jobs. Well, the job market, these companies want to stay in business, so they keep, either hiring people or they don't let go of people that they, probably could let go at this point, just because, if business improves in the next couple of months, then they'll need those people. But is that going to happen? We don't know. All right, one last article coming to us from Zero Hedge. It's titled, "The Party's Over. Atlanta Fed Slashes Q4 GDP Estimate from 2.3 to 1.2%. That's not good. All right, let's get to my summary here. All right, the Atlanta Fed's GDP Now model has revised its forecast for U.S. economic growth in the fourth quarter of 23, and the outlook is not promising. According to the model, real GDP growth at a seasonally adjusted annual rate is expected to be just 1.2%, a significant downgrade from the initial forecast of 2.3% made just a few days ago, a few days prior. This drastic revision highlights the uncertainty and economic challenges facing the United States in the coming months. The adjustment of the GDP forecast is based on recent economic data, including the construction spending report from the U.S. Census Bureau and the manufacturing ISM report on business from the Institute for Supply Management. These indicators have prompted the Atlanta Fed to reevaluate its predictions for key components of economic growth, such as personal consumption expenditures and private domestic investment, both which have been downgraded in the latest model. It's worth noting that the initial burst of economic growth in the third quarter of 23, which saw a GDP growth rate of 4.9%, was driven by factors like surging inventories and government consumption. These are not sustainable drivers of economic expansion, and the economy now appears to be reverting to a more modest growth trajectory. This abrupt change in the economic outlook is in line with concerns that the global economy is experiencing a slowdown, with Europe already in contraction and China facing its own economic challenges. The idea that the U.S. can decouple from the rest of the world and maintain robust growth is in such an environment seems increasingly unlikely. As the economy faces headwinds, the implications for policymakers, including the Federal Reserve, are significant. The possibility of a recession and the need for measures like interest rate cuts and fiscal stimulus could become more pronounced if these trends continue. Overall, the recent adjustments to economic growth forecasts emphasize the volatility and uncertainty in the economic landscape as it enters the final quarter of the year. So, it looks like, we had a little bit of a growth spurt here in Q3 and, just last quarter. And a lot of that, I've covered a number of articles. A lot of it had to do with government spending and, building up inventories and things like that. But can't do that forever. And, especially on the government spending side, because, we, the taxpayers, only have so much cash. And the way they're spending it, I don't know if they're what's going to happen. I mean, I have a general idea, but, I've been told not to be like a doomer all the time about the financial world. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.